Welcome to the Deep Dive. We're here to sort through the noise, pull out the key insights from some pretty complex material, all tailored for you. Today, we are really focusing in on the XDC network. You might remember it as XinFin. And our mission today is pretty straightforward. Figure out why this particular Layer 1 blockchain has gone all in on a very specific, very regulated, high-stakes area.
Yeah, this isn't trying to be the next big thing in gaming or NFTs. We're diving into an enterprise-grade platform built specifically, it seems, for two enormous parts of the global economy: trade finance and tokenizing real-world assets, RWAs.
That term you used, enterprise grade, that's absolutely central here. It wasn't just built for, say, raw speed. It was fundamentally built for compliance, for institutional trust. Technically speaking, XDC runs on what they call XDPoS, Delegated Proof-of-Stake. That gives it the speed, sure, and the energy efficiency businesses want. And crucially, it's EVM-compatible.
Ah, right. So Ethereum developers.
Exactly. Yeah. Anyone already working in the Ethereum ecosystem can pretty much start building enterprise apps on XDC without facing a steep learning curve. That's a big plus. That compatibility helps a lot, definitely. But, institutions need more than just ease of use. They need rock-solid reliability. The sources mentioned the network strengthening its foundations.
Precisely. The XDC 2.0 upgrade that finished rolling out late 2024 was a major step up for security. It brought in advanced Byzantine fault tolerance, BFT, which is, essentially a much tougher consensus mechanism. It ensures the network stays reliable and consistent even if some nodes have issues or, act up. This kind of hybrid tech approach. It directly targets what institutions demand: reliability, security.
Okay, let's unpack this then. Let's start with the actual problem XDC aims to solve. Because in trade finance, it's easy to underestimate the sheer scale of the funding problem they're tackling in the real economy.
Oh, the scale is almost hard to wrap your head around. The sources put that global trade finance gap at a staggering $5 trillion worldwide. And this isn't just like an inconvenience. It actively holds back global supply chains. And it really hits small and medium-sized businesses, SMEs, the hardest. They often just can't get the liquidity they need through traditional banks.
$5 trillion. Wow. Okay, so how does XDC actually propose to fix that? How do you turn this old school paper-based industry into something, investable?
It really boils down to digitization and tokenization. The idea is to take these traditional trade assets, think invoices, letters of credit, electronic bills of lading, EBLs, and turn them into digital tokens on the blockchain. They call it trade tokenization.
Yeah.
And doing this basically unlocks the value tied up in those assets, makes them liquid, lets capital flow in that probably wouldn't have touched the paper versions, and that helps bridge that massive funding gap we mentioned.
But for big financial players to get involved, these digital things need real legal weight, right? Cross borders.
Absolutely critical. That's why regulatory compatibility is so front and center for XDC. They specifically talk about complying with international standards like MLTR, the model law on electronic transferable records. Having that kind of legal alignment is a non-negotiable. It ensures these digital trade documents are actually recognized legally, giving institutions the confidence they need.
And it seems XDC is moving beyond just trade documents. The sources point to real momentum in the wider RWA space. What are some of the standout examples showing that institutional relevance?
Yeah, definitely some high-profile ones. We're seeing tokenized U.S. treasuries on the network already, specifically the USTY token from YieldTech that actually tracks a BlackRock-managed ETF.
With BlackRock involvement? Okay, that signals seriousness.
It really does. And it's not just treasuries. They also host Sharia-compliant gold tokens. Comtech Gold is the name. So this diversity shows they're setting up for standardized, compliant token issuance across different major asset classes. So if we connect this to the bigger picture, XDC isn't trying to replace traditional finance, TradFi, not at all. It's deliberately positioning itself as a bridge to TradFi, a secure, compliant digital bridge. They're building for the regulated world.
That makes perfect sense and leads us right back to that enterprise-grade idea. When we talk about actually making that leap, getting real institutional adoption, what's the specific technical key, the thing that lets XDC actually connect with traditional finance systems?
It has to be ISO 2022 compliance. That's the standard. It's the global language for financial messaging, basically dictating how data is structured and shared between banks, payment systems, everything. Think SWIFT, ERP systems, core banking platforms. They're all moving to ISO 2022.
And why is speaking that exact data language so vital?
Because if your blockchain can't communicate seamlessly using the exact same format and rules as a bank's core system, it just can't be a reliable backend. It won't integrate properly. By sticking strictly to ISO 2022, XDC essentially makes itself plug and play for these big institutions that are already required to use this standard. It makes adoption much, much easier.
And the sources really highlighted 2024, 2025 as being big years for hitting these institutional and regulatory milestones. Looking at the specifics, what partnerships really scream enterprise focus?
Well, there's a whole cluster of activity around compliance and custody that tells you who their target audience is. For custody, they teamed up with Utila. Utila provides institutional-grade wallets using MPC multi-party computation, securely handles billions in transactions. Then they brought in Elliptic for AML, anti-money laundering, and compliance analytics. That gives institutions the monitoring tools they absolutely need to operate under strict regulations.
And moving beyond just custody, they made inroads into high finance asset management too, right? Not just trade stuff.
Yes, the Libre partnership, that's a big one for high finance. Libre is actually using XDC to issue tokenized investment funds on-chain. We're talking strategies managed by giants like BlackRock and Brevin Howard. This lets qualified investors manage their fund shares directly on the blockchain, compliantly. And looking ahead, they joined the MiCA Crypto Alliance. That shows they're serious about aligning with upcoming regulations, specifically the EU's Markets in Crypto Assets framework.
Okay, here's where it gets really interesting, I think, because it seems the utility is expanding beyond just these big institutions potentially reaching everyday users.
Yeah.
Tell us about that Alinius partnership in Southeast Asia.
Yeah, that's a fantastic example of real-world utility hitting the payment space. Through Aliniate's platform called AliExPay, XDC payments are now live at, get this, over 34 million merchant locations across Vietnam, Indonesia, and the Philippines.
34 million. How does that work practically?
Yeah. The key is instant fiat settlement. So a user pays in XDC, but the merchant gets local currency instantly. No crypto volatility risk for the seller. It really shows XDC can handle high volume, super low cost, instant global payments. It pushes the use case way beyond just being a tool for trade finance professionals.
Okay, shifting gears from the business applications back to the tech itself. If you're handling massive trade volumes or millions of instant payments, performance, and cost, they have to be basically negligible, right?
Absolutely. Performance is baked into that XDPoS system. Transaction costs are incredibly low. The sources cite an average fee around $0.0004, almost zero.
Practically free.
Pretty much. And speed. Block times are around 2 seconds. Transactions usually reach finality, meaning they're irreversible within about 30 seconds. That's the kind of high-speed, low-cost performance needed for enterprise scale. Banks and big companies expect that.
And what about the network's resilience, its decentralization? That's always a huge point for institutions. We have to talk about the Nakamoto coefficient.
Right, the Nakamoto coefficient. It's probably the best single measure we have for decentralization. It tells you the minimum number of independent entities you'd need to get together to potentially compromise the network specifically, to control over a third of the stake or power. Higher number means more decentralized, more secure.
And for XDC.
The data looked really strong. As of July 2024, XDC's Nakamoto coefficient was 103. That's exceptionally high. It indicates a very well-distributed set of validators protecting the network. The structure involves 108 validator master nodes, plus another 198 standby nodes.
Okay, 103 is impressive. But we mentioned earlier, running one of those master nodes takes a 10 million XDC stake. That's a lot of capital. Doesn't that high bar, while maybe ensuring quality, also create a potential issue right from the start?
It absolutely does. That's the core tension, really, centralization risk. That 10 million XDC requirement plus the KYC needed for validators, it's a deliberate choice by XDC. On one side, it ensures validators are serious, well-funded players who can invest in top-tier security. That's what banks need to see. But like you said, it naturally concentrates power among a smaller group of these institutional actors. So there's this constant balancing act between being enterprise-ready and being truly open or permissionless.
That's a key trade-off. But despite that concentration risk, the sources did show these nodes are spread out globally.
Yes, the geographic diversity does help mitigate some risks. Nodes are running in 20 different countries. Singapore, Germany, the US are the top 3, but it's quite widespread. And maybe even more interesting is the type of hosts. It's not just crypto VCs. You have enterprises, data centers, universities, even government and public sector entities running nodes, specifically for trade finance applications. That shows genuine institutional adoption and buy-in for its purpose.
Okay, so given that structure, with the high requirements for masternodes, what does this all mean for you, the listener, if you hold XDC? How can you participate, secure the network, maybe earn some rewards?
Well, there are basically 2 main ways to get involved with staking. The first path is for the technically savvy, running your own self-managed full node. This means setting up the hardware and software yourself, and critically having that minimum 10 million XDC stake to become a master node. The upside, full control, direct participation in consensus. But yeah, it's a high bar.
Right, that 10 million XDC pretty much rules it out for most people. So what's the more accessible option?
That brings us to the second path, which is much more common, platform-based staking. Think exchanges like Bitrue. They often have programs like PowerPiggy or dedicated staking platforms like Bittime. These services handle the technical side for you. They usually offer options like flexible or fixed-term staking, and the APYs can be pretty competitive. Sometimes campaigns offer, up to 20% APY, though that varies.
So easier access, potentially decent returns. What are the broader upsides of staking beyond just the potential income?
Staking does more than just earn you rewards, although that's obviously a big draw. You're actively helping to secure the network. Your staked XDC acts as collateral, and there are slashing mechanisms that penalize validators if they misbehave, which keeps everyone honest. We're also seeing more liquid staking emerge. This is where you stake your XDC but get back a different token, like PEET SXDC, that represents your staked amount. You can then use that PEET SXDC token in other DeFi applications while your original XDC keeps earning staking rewards. It adds flexibility. Plus, staking often comes with governance rights, the ability to vote on proposals for how the network should evolve, and, you're supporting a more environmentally friendly proof-of-stake network.
Okay, that covers the how-to. Now we need the critical view, the aha moment, where we acknowledge the challenges, we've heard the successes, but what are the main hurdles XDC faces according to the sources?
Well, we already touched on the big one. That inherent centralization risk due to the high masternode requirements in KYC, that's an ongoing tension. Beyond that, competition is fierce. XDC isn't operating in a vacuum. It's up against established giants.
Like who?
Well, you've got layer ones like Ethereum, which just has this massive entrenched developer community that's hard to compete with. And then there are other enterprise-focused blockchains. Think Algorand, which also targets institutional finance heavily, and Ripple with XRP, which has deep roots in cross-border payments. XDC needs to keep proving its specific approach for trade, and RWA is better, faster, cheaper than these powerful alternatives. It needs to convince TradFi its specialization is worth choosing over more general platforms.
And what about its own internal ecosystem? If it's meant to be this bridge to TradFi, is there enough activity happening on the XDC side of that bridge yet?
That's another key challenge, ecosystem maturity. While XDC has landed some really impressive high-level partnerships, overall liquidity on the network and developer activity, they still trail the bigger, more established players. You can see it in things like GitHub metrics, stars, forks. The community is growing, definitely, but it's starting from a smaller base compared to, say, Ethereum or Solana. And one last point, really a reminder for listeners, if you choose that easier platform-based staking route, remember there's custodial risk. You're trusting the exchange or platform to hold your XDC securely. That's the trade-off for convenience.
Right. Good reminder. Okay, so that brings us to a pretty clear summary, I think. The XDC network seems to have carved out this very specific, very focused niche. It's aiming to be a low-cost, high-speed, compliant, enterprise-ready engine, almost entirely dedicated to the practical side of tokenization within those huge global finance and trade sectors.
Exactly. That dedication to standards like ISO 2022, the push into real-world payments with AliEx Pay, the partnerships with security firms like Utila and finance platforms like Libre, it all points to a very deliberate strategy. They want to be the foundational plumbing, the digital rails for regulated finance, not just another crypto coin. So, thinking about the future, given this intense focus on regulatory alignment, on integrating with TradFi using their own standards, the big question isn't if digital assets will become part of global finance. That train has pretty much left the station. It seems inevitable. The real question is whether a specialized, super compliant network like XDC can overcome those challenges we talked about, ecosystem maturity, liquidity, and actually become the default infrastructure that banks and corporations choose to run on globally. That's what you really want to watch. Can it win that race to become the go-to digital rail? Keep an eye on its progress in regulatory approvals and, maybe more importantly, its adoption rate in real-world trade finance pilots. That will tell the story.